Hello, this is Herb Morgan, Senior Managing Director and Chief Investment Officer at Efficient Market Advisors. We are a business of Cantor Fitzgerald Investment Advisors. This is our weekly economic and market commentary for the week beginning Monday, June 4th, 2018. The presentation you're about to see and or hear has been prepared by Efficient Market Advisors for use with both investors and financial advisors, each of whom are expected to make their own investment decisions. Nothing contained in this presentation should be treated as an investment advice, and there is no recommendations for the purchase or sale of any securities. With that, let's get started. Equity markets were mixed, with U.S. stock markets mostly higher on the week. Leadership continues for the year in the small cap space. It's interesting because small cap U.S. stocks are quite a bit more expensive on a valuation basis, but they did underperform significantly in 2017 and are having a banner year this year, up 9%. But international markets were down last week, mostly on some fears associated with some frontier markets, in particular Turkey and Argentina. Additionally, large developed international markets were spooked somewhat by some inabilities within Italy to form a coalition government. And when a coalition government was finally formed, the two parties are both Euro skeptics, sort of anti-Euro and anti-European Union. That sent a little bit of a shudder in international markets, but as you can see, the damage was very, very small. Developed international large cap down less than 1%, in emerging markets down only about a half of 1%. Fixed income was mostly higher as rates went down after rising significantly over prior weeks, and commodities down a half a percent, hedge fund index down about a quarter of 1%. Economic data was largely positive last week. The S&P Case-Shiller Home Price Index is now up 6.8% on a year-over-year basis. That year-over-year rate, if you look at the red line on your chart there, you can see that it is continuing to climb. And pending home sales were actually down a little bit, down 1.3%. That's the number of homes that are in contract but not yet closed escrow. Escrow we use out here in California where I live. What's interesting, though, is when you read through the report, you see that the biggest issue with home sales is a lack of inventory, a lack of supply available for home sales. Here's a chart that was put out by the National Association of Realtors talking about just that exact thing. This is the number of homes available and looking at January through December over a number of years starting in 2008. Now, you remember in 2008, of course, the residential real estate market did very, very poorly and was largely lower on the year. Look down at the very bottom of your screen. You see the black line and the red arrow. That's 2018. You can see it right here. So the available homes for sale, while it's up a little bit from the beginning of the year, is still lower than it was in every other year going back to 2008. That's a supply and demand issue, and that's the reason home prices are rising. Construction spending, though, is beginning to catch up. It was a strong rebound in April, up 1.7%, 1.8%, now about 7.5%, 7.6% higher than a year ago. Private residential was up, multifamily was up, single family was flat on the month. And consumers reported back that to the Conference Board survey that they are quite confident. They're feeling very good. Confidence consumers rose to a 128.0 level. The present situation component rose to a 17-year high of 161.7, and their expectations for the future got higher as well. Out in Chicago, the The Chicago Purchasing Managers Index for the month of May had a sharp increase. Here, anything above 50 says that business is rising, and therefore it's rising at a rather rapid clip because the number came in at 62.7. We also got news that April personal income continued to gain. It's up 3.6% on a year-over-year basis. Wages and salaries, which had been lacking in increases during the early part of the economic recovery, are now fully participating. They were up 0.4% in April. We also heard that gross domestic product for the first quarter was revised from a 2.3% number to a 2.2% number. Now, the Bureau of Labor Statistics, the Department of Commerce, rather, that puts out the GDP numbers, the Department of Commerce has methodology to smooth out seasonality. Winter is different than summer, is different than fall, and so forth. But despite the fact that they put this in there, first quarter is generally the weakest, and in many cases, it's even negative. So 2.2 or 2.3% in the first quarter of a calendar year is really quite good. In fact, one of the things I follow here is the Atlanta Fed GDP tracking number, which currently suggests that second quarter GDP will come in north of 4.5% growth. I think that number will be revised as we get additional data throughout the month of June, and I think second quarter GDP is going to come in north of 3%. I think 4.5% is just a little bit too much. Now, one of the things that's very important, and I talk about this a lot, is the level of prices in the economy and the level of inflation. This has a direct impact on our portfolios because inflation can have a very significant impact on bond prices. Bonds are a big component of our investment portfolios, and they can have, when they surprise, especially to the upside, they can have a negative effect on stock prices, at least in the short term. The Federal Reserve measures inflation many ways, but to determine whether or not they are meeting their statutory objective, the Federal Reserve uses core PCE inflation, and they look mostly at the year-over-year number. And core backs out volatile components of food and energy. It's the red line on your screen. Now, the Federal Reserve's target is 2%, and you can see the core number there on the far right is still a little bit below that. It's at 1.8%. So the Fed feels it is well below its objective and should not be in any particular hurry to slow down the growth of the economy. Later in the week, we began to get news on employment and jobs, and for across the board, the information and the data was quite good. Regular initial weekly claims for unemployment fell 13,000 to 221,000. That's near a 50-year low. The 4-week moving average rose slightly to 222,000. Two jobs reports came out last week, both of which are important. They're two separate entities. They have different statistical methods, so it's valuable to look at both reports. ADP, Automatic Data Processing, the nation's largest employment payroll services company, has a methodology based on looking at their own business to determine where they think, how many jobs they think the economy gained or lost in the year. ADP says that private payrolls grew by 178,000 in May. That's on top of 163,000 in April, but that April number was revised down slightly. The second employment report we got was non-farm payrolls. That's the one that's put out by the Bureau of Labor Statistics. They say that the economy added 223,000 jobs on top of the 159,000 that were added in April, and the unemployment rate fell to 3.8%. That's the lowest level not only in 18 years, but it's the lowest level I could find going all the way back to 1969. Now, what's interesting here is that we're starting to see that the great financial crisis and the Great Recession is moving into the rearview mirror. This is now 10 years behind us. Remember this when we were losing 800,000 jobs a month, or 200 or 400 every single month. Unemployment was going up, up, up. ever since that time, we have been adding significantly to American payrolls. One of the things about these labor markets reports of low unemployment, it's a regular criticism of people who don't maybe have confidence in this in the robustness of the labor market. One of the things they cite is that the labor force participation, that's the percentage of us that participate in the labor market and that work, is far lower. As you can see here, it's below 63%, far lower than it was, let's say, back in 1998 or 1999, where the participation rate was well up to 67%. Now, there's two ways to look at that. You could say the job market's not as good, or we can look at some demographic things that are happening in the United States. The baby boomers were 70 million Americans born between 1946 and 1964. So in 1966, the labor market participation rate was only about 59%. Only about 59%. When the baby boomers began to turn 20 and enter the workforce, the labor force participation rate began to rise significantly because a greater percentage of our population was in their working age. Prior to 1966, they were children. Well, after 2006, that's when the first baby boomers turned 60. Some people might have retired even sooner at 55. But the first baby boomers turning 60 coincided with sort of the beginning of a decline in the labor force participation rate. And now it seems to be leveling off. Now economists disagree on this. We at EMA are a little more in the camp that the participation rate decline is related to the demographic shift and not to structural problems in the economy. Average hourly earnings had been stuck in neutral. Small percentage gains on a year-over-year basis of about 2%, which were okay, but not, of course, what we'd like to see for our country people. And as you can see from the chart here, average hourly earnings are starting to increase. In the month of May, they increased by 0.3%. They're now 2.7% higher than a year ago. This is what they call a real number, which means it backs out the effects of inflation. It does mean, and it should mean, that the standard of living of the worker is going up by about 2.7% per year. Now, Americans are getting quite a bit more optimistic about both the economy and the labor market. This is a chart I pulled from Bloomberg, which is sourced from the Conference Board. You can take a look here and see that the people who respond to surveys saying that current conditions are good and that job markets are plentiful are at highs not seen since 1999 and 2000, right before the modest recession that we got at the beginning of the century, and certainly at levels well above where we were before the Great Recession. The confidence, according to most economists, is sort of a self-fulfilling prophecy. If people feel confident, they'll spend. If they spend, then the economy, of course, would do well. Okay, rounding out the week, we also got the Institute for Supply Management's manufacturing PMI. Manufacturing is about 15% of the U.S. economy, but there were some interesting reports this week about how competitive U.S. manufacturing has become in the last few years. That number came in really strong, 58.7. New orders, which suggests what future economic activity, including hiring, will be, came in at a very strong 63.7, and employment rose up to 56.3. Next week, we've got plenty of economic data on tap. We've got factory orders for April. We've got the services or non-manufacturing PMIs, which are about 85% of the economy, is expected to be very good. Job openings, or JOLTS, which is now exceeds the number of unemployed workers. I think that'll come in around 6.5 million. We've got productivity and labor costs along with the trade deficit. Trade deficit is a big political topic at the moment as the U.S. is negotiating with all of its trading partners, all of its big trade arrangements. Thursday, jobs claims and consumer credit, wholesale inventories on Friday. Thanks as always for tuning in. I always look forward to talking to you, and I'll see you again next week.